Good evening, traders. Welcome to the Monday Open Holiday Edition. I'm your host, Craig Shapiro, macro strategist here at NinjaTrader Live. It is February 16th, 2026, and we are live this evening on the Monday Open after a holiday day off, President's Day. Hope everyone enjoyed the time off. Futures are about to open. We have a great panel for you this evening, like we do every week. What we'd like to do is go around the horn, look at the various asset classes, get some perspective from three of the greatest traders around. So just a quick look at the tape here as we open up on this Monday. S&Ps are 68.56, up 6 handles. I think we're looking at it versus the close on Friday. So obviously there was some trading yesterday. NASDAQ 24,753. Russell is down 25 basis points, 26.46. Finally, I think for the first time in quite some time, we've seen gold and silver down to start the week. That's a new thing. And so we'll talk a little bit more about everyone's perspective on precious metals. Bonds are strong to start the week, and the dollar is mixed, maybe a little bit stronger. So plenty to get to. Last week was a wild week, a lot of unwind under the hood. Indices closed a little bit lower, below some of the key levels I know Pax wants to speak about. And we got a big week coming up this week. It's options expiry week. We have Fed minutes this week on Wednesday. We get some key macro releases, potential Supreme Court ruling on Friday. So a lot to get to, a lot to discuss, a lot going on. But first, let me introduce the panel. Sara is back, checking in from beautiful Southwest Florida. Welcome back, Sara, after a week off. Pharm is here, and Pax is here. So how's everyone doing this evening?
Awesome.
Great.
Nice long weekend.
Very good.
65 and sunny all weekend in Chicago. It's beautiful here.
Nice.
No more complaining about weather down here in Florida. We have a big week this week. A lot of the NinjaTrader folks will be down here, so it's exciting to have everyone down here for a beautiful week of meetings and stuff. But look, last week was an interesting week for the tape, and I've been talking about this on the morning show. Just a lot of the unwind that we have been seeing under the hood. And indices really hadn't reacted, but they started to react, and there was some weakness. And so, look, I think as we approach this week, I'm curious. Maybe we can shift over to Sara's charts. Let's talk about the indices. Let's get a perspective from you. How are you thinking about the setup for this all-important expiry week?
Well, as strat traders, we are very excited for this coming week because last week we stayed an inside week all week. So there was some opportunity in there last week, but pretty indecisive. And overall, pretty much we've been pretty well sideways for a while now. So not getting a whole lot of movement, but what we're watching is for a break of last week's range. Preferably downside because we're a lot closer to triggering the downside, which is below 68.09. And then we would target this pivot low here at 67.51. And NQ is also an inside week, so same setup. So this is something that we would consider to be a simultaneous break, which is just multiple things doing the same thing at the same time, right? Like simultaneous. So we'd also be looking for a break of NQ below 24, we'll say 580 for simplicity's sake, targeting previous week's low. And then this big gray box, this has been the range that we've been trading in this whole time since November. So we've still just been relatively sideways. Again, there's moves to be made, there's trades to be had, but stuff like this we're really interested in. But as always, the line in the sand is last week's lows because one of two things is going to happen. We're going to trigger and stay below last week's lows and hit our target, or we're going to trigger and come back up and through and go outside week. So if you're to be short, you have to be below last week's lows. So hopefully that gives you guys some clarity. And then if we do hit this low, then we've got the quarterly trigger, which is this turquoise line. I'll show you the quarterly chart. This would be, this would be the first reversal since April of 2025. So that would be great. I know Pax wants the market short the beginning of the year, so do I, but we got to get below last quarter's lows, and with these inside weeks, that's how it's gonna start if we're gonna get down there. So that's what we're looking for. We're short biased right now, and we got to stay below last week's lows.
Last week we saw in tech just a massive dispersion trade. You know, a SaaS apocalypse has been going on. The software names have been getting annihilated. There's been a flight into semis, into memory stocks, into things that really could benefit from the AI capex. But there was clearly more and more concern about the deterioration of profits going in the software sector. And really up until last week, we hadn't really seen it at the index level. So it is interesting finally I know Anthony been talking on the morning show just on violently unchanged, for the year across the indices, across minis and across the NASDAQ. But it seems like last week we finally did do some damage in packs. I know we're below your 25, 480, 478 level, but how are you thinking about NASDAQ as we start the week?
From a swing trading standpoint or from a longer term, like a trend trade, I wouldn't buy the NASDAQ with my ex-wife's money. If it's the NASDAQ is under tremendous pressure, which is a considerable amount, by the way. The NASDAQ is under tremendous pressure. We're 700 points lower on the year, 650, almost 700 points. We are 500 points underneath the quarterly pivot of 25,132. We are working, Sara was talking about an outside reversal quarter in the S&P is 65.30-ish. It's depending if you're looking at the RTH or ETH, 65.25 versus 65.39. But in the NASDAQ, that price is 23,904. That's one day away. 23,904 would be an outside reversal in the quarter. Now the S&P is still 300 points away from that, right? 5, 6, 7, 8, 400 points away, 350 points away from it. The NASDAQ is 800 points away from it, but the NASDAQ can get there quickly. So I don't know. The NASDAQ is under pressure. I don't know what this bond rally means, for the equities. I'm not sure. I don't think it would be. Yeah, I don't know. Listen. I've never seen a bid I haven't wanted to hit. So I came into this year bearish. I came in. I said, I think in October, beginning in October, that the S&P was going to target. You can go back and watch. I started saying in October that the S&P was going to target 69.83. And then it was going to have a very difficult time getting over that. And after the first year, we're going to see a lot of back and forth volatility. And then we're going to see a sell-off, and we're getting that back and forth volatility. And the S&P is inching lower. In that back and forth volatility, the NASDAQ is trading lower. I don't know if that makes any sense or not. But the S&P it's drifting lower with these big intraday ranges. The NASDAQ, those big intraday ranges are selling off pretty hard. So, from a trading standpoint, let's see what the opening range gives us tomorrow. There might be something to do on the long side. See what the late day trade does. From a trading standpoint, you're looking for a nice short term, little scalperoo for 20, 30, 40, 50, 60, 80 points. If you're looking for the rotations and we get a rally out of the opening range tomorrow in the NASDAQ, look for 65 handle swings. But from a broader standpoint, I don't think I'd want to be long.
Yeah. Sara, I'm curious, is the character of the charts as you see it different between the NASDAQ and S&P at this point? I mean, I know, NASDAQ's been weaker, but are we getting to a point where we think NASDAQ can drag down the S&P, or is it likely that this dispersion, this rotation trade we've seen, even into Russell kind of alongside can continue, for the next little bit here? What are your thoughts there?
Well, I think if the NASDAQ starts going down, yes, the ES is stronger in a sense that we're a lot further away from a quarterly reversal, but we're not very far away from like the last weekly low. But if NASDAQ starts really tanking, it's for sure going to take ES with it. So, NASDAQ's definitely been weaker. So,
and then what about like the Russell? I mean, I know you look at that as well. The Russell's obviously been stronger, but I'm curious, like, can this dispersion that we've seen now really for the last, 4 or 5 weeks, is that likely to continue, or are we more likely to see a more correlated move where indices are kind of all working together? My sense fundamentally is we're going to see a more correlated move here because correlations are pretty low. Dispersion trades are very, very long. We've seen a ton of unwind already. And so my sense is we're going to start to see, more correlated moves. I don't know if it's evincing itself yet in the charts as you guys look at them, but I'm curious your thoughts there.
So it's kind of funny, like ES and NQ pretty much correlate with themselves, and then RTY and YM correlate with themselves. But at the same point in time, they're all set up for weekly downside setups. So we should get all 4 of them going down at the same time this week, I would think. because the upside failed last week on RTY. Technically, it didn't fail on YM because we did hit new all-time highs, but it closed weak, right? So we're closer to taking out last week's lows. So this would be a, four-way simultaneous weekly break, which gives us a lot of evidence to want to be short.
Right. I mean, from the macro perspective, we're through kind of the big data releases. Last week, we had non-farm payrolls come in on I forget what day it was, Wednesday, right? And, came in stronger than expected, and the market, didn't really like that. And then inflation CPI reading came in, basically in line to maybe modestly weaker than expected, and the market didn't really rally on that either. And so, we're kind of through some of that macro stuff here for for a little bit, and then we're into expiry week, and typically on the other side of expiry week we start to see more of a correlated move to in the week or two kind of following expiry. Typically expiry we get the options activity back and forth, and single names are going all over the place. But as we push through this week and into the back half of February, I suspect we're going to see a little bit more of a correlated move here. But curious, Pharm, how are you thinking about the setup now for S&Ps as we approach the back half of February? And an important VIX expiry Wednesday, regular expiry Friday. What are the charts telling you here?
Yeah, I mean, that dispersion has been, truly incredible, right? And the Dow and the Russell at times have been very, very strong, and so this NASDAQ weakness has not really yet translated into ES, but it does look like the Dow might be ready for a breather, and the Russell really. So to me, what's going to happen now? Like, are we going to get suddenly the NASDAQ going to get strong? And it's going to be kind of hard to buy that personally. If not, then we're just going to sell, right? But if NQ can find some semblance of strength, then maybe ES chops around a little bit. But I've got the NQ chart up first because it has driven to the downside, even though ES again it just hasn't really kind of gone anywhere yet this year. But I do still see it as the most important. And I think the first thing to touch on is that we just talked about the quarterly on NQ. And for me, a few weeks ago, talked about that big yearly level for me, which is roughly, it's kind of a big range, but it's on a yearly basis. It's not, but 24,069 to 24,369, that range we came down and tagged after hours. I guess it was 2 weeks ago now on Thursday. That's a big hold. Very, very bad things probably happened below there. Certainly nothing good. And then ES also held again 2 weeks ago, and then last week its own big level, which is structurally in a wildly different location from NQ, but also very, 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 very critical. Just call it 6,800 if you want. So both big spots have held big downside tests, but from the bearish perspective on NQ in particular, I recall again a few weeks ago talking about this 25,516 to 25,538 spot, which is a value area low for January. And there had just been that persistent buyer in that area. He's dead. So we had his funeral a couple of weeks ago, and then just stomp on the flowers on the grave. We came up there and sniffed his break even last week, and then ran away from it. Right. So 469 basically is now, if you want to just make it a very nice number. Would be sort of a key level to reclaim, but really up there in that 500. So we are building volume now. So, we're like halfway through the month, right? But as of now, value is gapping lower on the month. Like generally bullish things aren't happening in that scenario. So that's kind of the big picture. And then coming into this week, we've got, this double distribution week on both ES, actually on YM as well. So ES, YM, and Q, we've got this big double distribution week with sort of a larger, especially on ES, it's kind of a really big, like low volume MAW. Can't even call it a node on ES. That's just, it's kind of, it's pretty wide with two sets of singles through. NQ has the same, double set of singles here, but you can see that like Monday's low was kind of right here in this 947 and 969. So remember that spot from last week, we hit it on Monday. That was a low, fired off of it. And then now we're finding offers there. So this week, then I'll shut up and give somebody else a chance to talk. It's really all going to be about does price continue to build out volume down here in this lower distribution? So let's say below 947 and 969, or are bulls able to reclaim, this upper distribution? And again, both for ES and for NQ, it's a very similar picture. I'll flip over to ES for just a minute. And then I am just going to add that I see a scenario here where, like, if we get one of those days where NQ is strong and it's leading, where, and then ES is lagging, I do think it's a situation where we could potentially see a failed reclaim. I'm going with 25,169 to 25,179 as being sort of like a key reclaim representing this upper distribution up here. I see a decent chance of a failed reclaim on NQ if ES is structurally lagging and it's sort of in its lower distribution for the week. That could then actually sell back off. And if so, it would still have to get back below 947, 24,947 and 24,969 to like really be bearish. But I could see that playing out. So just be very careful on rallies, I think. And then, anywhere in this low volume area for NQ and also for ES, it can be like a little bit awkward. We would think that sellers would control that area broadly. They did on Friday. The high was kind of shitty, but there really wasn't like a taper in interest from the buy side. But like structurally, the high is not really that great, relative equal highs. ES, that high was even worse. So I'll flip over to there and you'll see like that low volume maw there on ES. So it's much bigger separation between these distributions. So same thing, below 68.98 to 69.02, building up volume there, I believe, is building potential energy for a push lower. Whereas a reclaim of, I'm going to call it 69.51 to 69.53 starts to look a little bit better. I again feel like there's less of a risk of a failed reclaim on ES, but it has gotten to the point where we do now have a fair amount of inventory trapped overhead on ES, which has not been the case for some time. We're finally starting to build a little bit of volume below 6,900. It's not fantastic. So like the ES chart, like it's so close to like making a new all-time high. Like it's really close. I mean, if you reclaim 6,950, you're back in this upper range. I mean, like new all-time high is like a day away, right? So there's nothing horrifically bearish on the ES chart. But the risk then, of course, is if we do start to see a little bit more correlation to the downside, YM is weakened and NQ is not picking up the slack. So again, both charts, I feel building up volume down here in this lower distribution is bearish potential energy for a move lower. Again, we have those really, really big spots below us. So like, I mean, I would be careful chasing a short down there. But I mean, if we are truly offering, again, call it 6,800 from below on ES, that's the last 2 weeks cash hours low. Again, we did have that excursion after hours down to the 69 or 67.50s. But if we're truly offering the lows of the last 2 weeks, then to me, it's very clear downside. And so that's where I'm at here, right? It's NQ has definitely been like pretty busted up, but a big spot below. ES like hasn't gone anywhere, but maybe now finally starting to see some signs of cracking. And I feel like this is going to be a big week. And if we get into options expiration and some of that dispersion sort of unwinds, which I feel like tends to happen into some of these OPEXs, and we get some correlation to the downside, then certainly look out. But a lot of key reclaims for bulls to get on really both indices to feel safe with longs for me.
Yeah. Pax, I see some back and forth in the chat about not trading seasonals. I did want to point out that I think it's the second worst seasonal period is the period between Valentine's Day and St. Patrick's Day. And so we are entering into that week period. It coincides often with the February to March expiry period. I'm curious your disdain for trading seasonals. What's the vibe there? What's the reason behind that?
Most people have no idea how to do it. So you see it on social media. They're going to see it on social media. They're going to see it, in the More report, or something else like that, and think, well, I can buy them here. I can buy these dips. I can buy these dips. And then when the market just completely runs over them, they're wondering what in the hell happened. The last 13 out of 15 years, the market's rallied in the last, day. So I don't know, unless you really know how to handle those trades, and most of those seasonals, are going to be for commodities and spreads, and the people that know how to spread those commodities and spread those markets, they also know how to get out of them when they're wrong or add to them when they're right. There's so much nuance. There's so much fine line nuance to this business. We're traders, at least I am. And I think that the majority of the people in the chat right now are too. So I'm not paid to think, I'm paid to react. I am paid to take more points out of the market than what I spend. That's it. So if, like Pharm is saying, be very careful being long, S&P, you can't be long NASDAQ until we reclaim, I don't know, the quarterly pivot, but be careful being long NASDAQ. Look, these levels, or the S&P, every time that I've gotten a bug in my ear about what the market is going to do, or, seasonals, or, this stat or that stat or this stat or the other stat, I've gotten destroyed. When I've taken it easy and I've simplified my trading, and I became that guy that Bruce Lee said, I don't fear the guy that practices 1,000 kicks. I fear the guy who practices the same kick 1,000 times. I want to strip away all of the ancillary stuff from my trading, and I want to make money. That's it. And so, for me, that means that the S&P is below 69.02, the yearly open. We are churning 69.35, 69.65 right now, which is a level I've been talking about every week. We are just above the 100-day moving average, which is 68, I think 68.40. Hold on, I got a quarterly up. 68.48, I think. The NASDAQ 100-day moving average is 800 points away or something. It's crazy. It's hard to be along in this market. Now, also, we were talking earlier before we came on, and I've said this a million times. You guys have all gotten used to buying dips, and that has rewarded you, right? I mean, if you've been buying dips since 2009, since March of 2009, if you've been buying dips, you have been greatly rewarded, from an investing standpoint. From a trading standpoint, you could have gotten destroyed over and over and over again. Like, last year, what dip are you going to buy? 6,100? You're going to buy the 50, the yearly opening range is 59.49. You're going to buy those? Or are you going to buy them at the quarterly pivot, 58.40? Or are you going to buy them at 55.09? What dip are you going to buy? Meanwhile, if you're trading the market that's in front of you, not the one that you think it ought to be, you would have made an ungodly amount of money on the downside. And then when the market started its reversal back up, you could have deployed some of that capital into longer term trades and longer term accounts and bought some names and made another fortune on the way back up. But when you're sitting there trading your opinion, eventually you're going to be right. But how much money do you need to lose before you get there? If you're right at the wrong time, my brothers and sisters, you're fucking wrong.
Yep. One of the things that we speak about a lot on the morning show is the flows and the zero data expiry option flows that are there every day. And now with single stock zero data expiry options for the Mag 7 names, Mondays and Wednesdays and Fridays now. So we're seeing a huge impact. I'm curious, maybe last week, did you notice, this is for any of you, that Wednesday was kind of the first day in quite some time where the zero data expiry crowd actually lost money. We didn't rally back. We closed them on the lows. And even on Thursday, similarly, kind of a similar situation. We need to start seeing some losses from the zero data expiry crowd to actually get the range expansion, to get larger moves. I'm curious if you're seeing anything in the volume or anything in the ranges that suggests that the power of the zero data expiry crowd can be overwhelmed. As we move. Is there any indication of that?
It's too much thinking for me, Craig.
Yeah.
Yeah, I wanted to be short last week. There was some really good tradable volatility, and I caught that. But I'd be actually interested to hear what Pharm has to say about it, since he's more of a volume profile, trader. He's looking at the profile much more than I do.
The zero day side. Keep in mind you have all kinds of flows in the market, all kinds of short term flows, and all kinds of longer term flows. And at least, from my perspective, it hasn't changed a whole lot of my analysis. The zero day effect really hasn't changed. I just consider it an alternate to trading ES, really. And so longs are going to take longs at good locations, and shorts are going to take shorts at good locations, and when longs, broadly are off sides, they're likely to liquidate, and when shorts are off sides, they're likely to liquidate. So it hasn't really meant a whole lot to me. I do feel like in many instances, you get into a big, gamma vanna level, right, to the upside. There's different types of trades that you can take, right? Like a call liquidation. If a bunch of call buyers are buying a bunch of calls into a big dealer spot, they can't get through. What are they going to do? They're going to puke them, right? But most of the time, that's like a key structural area on a volume profile anyway, where I'm not being an asshole pushing along. So it just brings up different types of trades. But to me, when big money decides to make big decisions, it doesn't really matter a whole lot what 0 day is doing. There's a lot bigger money out there than dealer profiles and dealer hedging dynamics. And
Right.
My friend Ball Signals will be the first one to tell you that, even as a former market maker and having a platform, talking about dealer dynamics, that there is bigger money out there that will push this thing around, and it doesn't matter. If and when big money decides to sell, all of that will change very quickly.
Yeah. No, I guess that's kind of what I'm hoping for, or thinking about, or trying to figure out when that's going to happen, right? Because it's been some time since we've seen that those bigger piles of money overwhelm the very short term 0 day money. We also are in an expiry week this week, so you have a lot of the hedge buybacks, and then as we push through this week, then you're into that more of that window of potential weakness where the dealer hedges are less as an overall percentage of the volume flow. So if we get the real money to actually come in and start to be more concerned about the economy slowing, or the pace of AI deflation, or a variety of other things, geopolitical things that are going on, then we could get into a more protracted, highly correlated move to the to the downside here, which I think many of us are, I'm not going to say hoping for, but maybe expecting, given our given some biases that we have. But just a quick look here at the tape, kind of quiet. Reopen here on the Monday open. S&P 6861, NASDAQ 24,775, down 30 handles. Russell down 24 basis points. Pax had mentioned the bonds; they're a bit stronger. I want to shift though to it looks like the best performing commodity for the first time, I think, in quite some time on this show, crude oil. Up 1.3%, 63.72. I know there's been a lot of positive bias, at least on the morning show with Deli and Shai, about the outlook for crude. Maybe Sara, can we flip over to your chart here on crude? What are you thinking for crude, the outlook this week? I know there's some potential meetings with the U.S. and Iran this week. The military buildup in the Middle East continues to grow. A lot of back and forth about whether or not a deal can be struck with Iran, or if we're going to be doing something more, more militarily in the region. What are you thinking here on crude?
Crude's kind of funny to me because it's like lagging majorly behind like the rest of the energy sector, like XLE and OIH, XOM, like all the like gas tickers and energy sector is like all the way up at all-time highs, and crude oil is just kind of like lagging a bit, but I'm still bullish on it. It's just we're in this little internal broadening formation. You can kind of see right here. Well, here's like your range, and then you've got high, low, new low. So they're trying to come back up and make a new high. I've been bullish ever since we took out that 55 level, and it's just kind of chopping sideways right now. But yeah, I'm still bullish on it. We're still above the quarterly trigger. We're still above the monthly trigger. So still bullish, yeah. It's just, like I said, kind of chopping a little bit.
Yeah. I think that dynamic that you mentioned there between the commodity and the equities, I think really shows kind of what's going on under the hood in the equity market, right? I mean, the dispersion in the equity market out of tech and into other areas, whether it's the Russell, whether it's energy, whether it's materials, right? You're definitely seeing that evince itself here. And so the energy sector ETFs have been basically up and to the right, to start the year, even without participation from the commodity price, right? We haven't really seen. Look, we've seen some constructive commodity price momentum in gas and in crude, but it hasn't been to the degree that the equities would suggest that at all. And so it is indicative, I think, of that dispersion trade and those unwind trades continuing here and kind of pushing some of the little bit of capital out of Mag 7 into other areas has a big percentage implication on these other sectors here. But I think it's a big week for crude. I mean, hard to trade overnight given the uncertainty around the geopolitical stuff. I think there's been some back and forth about whether or not anything militarily can happen during the Olympics. Typically, we don't see things happen during the Olympics. We see things happen right after the Olympics. So that happened in 22 and 24. And so, and in 2008, there was some activity after the Olympics. So again, I think it may be naive, to say we can't do anything during the Olympics. But if that's the case, then, we got another week here before the U.S. does anything. Pharm, any thoughts on crude profile here?
Yeah, definitely I do like crude as well. Same thing with Sara. We were both looking for it to come down and take that April low to really be able to find some meaningful strength. And I would say basically above this holiday session high, which was like 63.90, something like that. It could potentially find a rotation up to, I'd say, like 64, 69. But I agree with Sarah's analysis that it's kind of stuck right now. Though the last time I said that, I think I said it about silver and it just went on a moonshot that week, but it still actually ended up staying in range. But it was a big move right after I said it. So maybe I will jinx crude and it'll just go up and rip up towards last week's high or something like that. So it looks a little bit choppy, but I am bullish. I'm actually looking for some kind of sell-off on, maybe the Iran situation isn't as bad as we all thought. So they just sell the shit out of crude. And then I'd be looking to buy it at that point. I really hate trading crude around some of these escalations, de-escalation situations. Just a big pain in the ass. I mean, just let me trade the instrument. But that's kind of what I'm looking for. I want to see, maybe that war premium come out, I guess, is the best way to say it, and see how it performs then, right? Does it resume its prior path to zero and back to negatives, or does it find a bid again one more time? So that's what I'd be looking for in order to find some kind of a decent entry. And I just don't like messing around with it around these times because, like you said, you try to hold something over a weekend and then you just end up getting blown out of a position. So I'm definitely very bullish on the energy sector in general, and seeing that rotation out of tech into some of these other areas, I think is definitely a good thing. So I've had my feet in the energy trade a couple of times, and I'm definitely looking to get back in on this one.
Yeah. Pax, any final thoughts here on crude?
Every time I get long crude, I make a little money and I get stopped out. So, I'll leave it to macro crude strategists like Tracy, like Shy, to give me a macro outlook on it or continue to. But from a trading standpoint, the long crude trade is getting awfully crowded. And we're not really rallying, so that's kind of scary to me. It makes it more difficult. It makes me reticent to buy it again.
Yeah, no, that makes sense. Maybe let's shift gears. It's been 33 minutes. We could talk about precious metals. Typically, we're sitting here on Sundays and talking about how constructive precious metals are trading. But to start this week, seeing a little bit of a check back. I think that the gold story remains really fully intact. The geopolitical stuff, the store of value trade, a weak dollar trade, a variety of reasons to own gold. And I think over the course of the last few weeks, we spoke about this with Blake last weekend, just the gold to silver ratio has been improving, and gold's been outperforming silver a little bit here over the last little bit. Kind of makes some sense. Sara, what's the outlook here? What are the levels for gold and for silver that you're looking at?
I think we're going to chop around in here for a long time. This range, it's just not going anywhere now. That sell-off was too big, and we're just kind of stuck inside of it now. We had an opportunity last week to try and go back up to the all-time highs. It's just, I feel like everybody used all their buying power up or something, because nobody showed up to the long party last week. And I think it's just gonna, like I said, chop around in here for a while. Silver looks a lot weaker. a lot closer to the downside, because if this was the same range, right, we're a lot closer to taking out these lows, whereas gold is rather far away. Gold's more in the middle of this range. So I would just expect choppiness there. Again, silver a little more bearish, a little easier, I feel like, to be short if we go below last week's lows. And then you would just target that low. So there's more of a clear trade on silver than there is gold. Gold's going to chop you up, I think. So be careful.
Yeah. No, one of the things that certainly we've seen is the volatility across precious metals has dissipated over the course of the last couple of weeks. I mean, I think that's only to be expected after the massive vol spike that we had kind of through much of January, right? And so it seems like we're sitting here, vol's coming out, gold's kind of buying time a little bit better than silver is. Silver is struggling more with vol falling down. You kind of have a bit of a spot down, vol down situation in silver, whereas gold's kind of holding in low. But silver really outperformed on the way up too. So probably just some overall digestion there. But Pharm, any high conviction thoughts here on either gold or silver?
No, not at all. I agree. I think it's time for some vol to come out of there a little bit, which doesn't necessarily mean upside like we always tend to assume with equities. Like silver in particular has got a decent high and a decent low. We're well inside of that. When I see that, there still can be very good trades. I generally would look for failed attempts at range expansion, I would say, and I'd fade them into some kind of a mean reversion slop vol crush in the precious metals complex. I don't think they're going anywhere anytime soon, but maybe I just jinx that as well. So we'll see. But I have no interest here. And messing around with these, I'd have to chart them every day and look for specific setups, and it would just be a day trade for me. But no swings. I don't see anything on a swing basis setting up right now.
Yeah.
Yeah.
Pax, what are your thoughts here? Anything?
I think gold is a pretty good trade. So here, write these down. Those of you paying attention, they won't change. 50-25 is the dividing line. 50-25 and gold. Silver, I don't want anything to do with. 50-25 is the dividing line. If we can trade above 50-25, then look for that swing completes at $92, $91, $92. So look for 51.15. If we cannot get above 50 quarter, then look for a swing back to 49.40 to 49.50. If we take out,
hold on, I'm trying to do your levels.
Oh,
what was the lower one? 49.50.
Yeah, 49.40.
49.40.
Mm-hmm.
Okay.
And then another $92 underneath there completes the swing. Now, if we get below, here, I'll tell you what, I think that's, just call it 48.50. It's like 48.60. So 49.50 to 48.6 to 48.60, and that's where the swing completes. Gold has been trading in $92 ladder rungs, so to speak, with 185 points, $185 swings, 185 points, dollars, either one. So look for those swings. If we can sustain a bid, above 50 quarter, which it doesn't seem like we can, then we'll target back. I mean, we've got like interim highs, daily highs that we need to get above, like 50.70, and then we're back up to 51.15. So if you buy 50 quarters, take something off in front of 50.70. We go 50.70 bid, buy more, and then you take the money at 50.15. If we get above 50.15, then you're long up to 52. I think it's like another $92. So 52 even. Okay. On the downside, you're short below 50 quarter. You're going to take profit at 49.50. We get below 49.50. You're going to sell more. You're going to take profit on those at 49.10. Underneath 49.10, you're going to take profit on them down to like 48.60 to be safe. But we're stuck in, the ranges are now starting to compress, so when something geopolitically happens, or, the big boys and girls start to sell the indices off and start to override the influence of the zero DTE options, guys, that we were talking about earlier, and the markets start to fall apart, then gold is going to break out of the range. Right now, everything is range bound. Everything is waiting. Everything seems like it's sitting on a ledge.
Yeah.
I've traded these ledge markets a lot. And fortunes are made and fortunes are lost. But if you manage your risk, then you're going to put yourself in a pretty big position to be able to capitalize on it one way or the other. Right now, it feels to me like it's, or all evidence is pointing to the downside. That doesn't mean that we, like another Pharm made a case for the, not a case, but, made the point that if we start taking out some of these upper levels in the S&P, 68.65, 69.02, 69.35, 69.80, then we'll see all-time highs again. Okay, I'll sell that. If we get above it, then I'll be long. I'll start building a long position.
One of the things that gold has going for it, obviously, is the weak dollar construct, and more and more folks getting behind the weak dollar trade. That being said, I'm just noticing here a report out of B of A's FX desk. Dollar positioning turned the most negative in over 14 years in February, according to B of A's latest FX and rates sentiment survey. Short bets against the dollar are now at their highest levels since January 2012. The earliest data point available.
Wow.
Fund manager dollar exposure has dropped below last April lows. Concerns about the Fed independence and Trump's talk. And so, look, I think they know the dollar weak trade is a consensus trade. It's been the right trade. DXY has been weak. Dollar crosses have been largely weak. We talked with Blake about the strength in Aussie, the strength in Mexican peso, the strength in the Rand and the Real and a bunch of different EM currencies. But positioning is getting more stretched in weak dollar trades. And to your point, Pax, I think if we started to see more of a correlated equity sell-off, the pain trade would be dollar strength, which would likely exacerbate that. And so I think what we've been talking about now for the last several weeks is we've been seeing pockets of volatility move cross asset. We've obviously picked it up in precious metals. We've seen it a little bit more in FX. We've clearly seen it in Bitcoin. We'll talk about that. And then under the hood in equities, there's been violent dispersion, right? I mean, there's been names down 30, 40% across software and things that are being displaced by AI. There's names up 30, 40% with respect to energy, other parts of the AI capex, the value factors, and other various quant factors have been all over the place. And there's been evidence of deleveraging and quant unwinds already over the course of the last couple of weeks. It's kind of tremors before a larger earthquake. But now that we're starting to see, the volatility come out a little bit of precious metals and maybe come out of a little bit of the bond market, if the equity market doesn't pick up on it, and right now the VIX is at 20 and in negative gamma, but if we start to see a fall, that's kind of how you get that more relief, and we can start to churn out some of those higher levels in S&P again. This week is from a data perspective, is not a big week. You have ADP weekly tomorrow. You get the ISM, flash ISM later in the week, core CPI on Friday. One potential newsworthy event Friday, the Supreme Court has put out their calendar again for opinions, and we may get a tariff opinion as early as Friday. If it doesn't happen on Friday, it could happen next week. Either Tuesday or Wednesday have also been deemed opinion days. We got to keep that in mind. I mentioned the VIX expiry on Wednesday, regular options expiry on Friday, and then next week on the 25th after the close is NVIDIA earnings. And so clearly all eyes will be on that. And so the thought that volatility is just going to dissipate here and go back down to low to mid-teens again doesn't seem likely. But if we got that, then some geopolitical stuff going away, or Trump got a little bit more dovish on tariffs, whatever the case may be, that's how you can start to carve out those higher levels again. I don't suspect that's going to happen, but like you said, anything's possible. So, but just a quick look here. The tape is kind of turning a bit more constructive here. S&P 68.65 up 15 handles. NASDAQ's gone from red to green, back up to 24,809. The Russell is underperforming, so we'll see if that out of Russell into NASDAQ stuff rotation this week actually plays out, or if it's just kind of more of the same. Dollar is a little bit stronger. Dollar yen up to 153.60. Dollar euro 118.5. Bonds, we could flip to bonds real quick here. I don't know if either of you have charts on bonds, but Pat, you were mentioning kind of the strength of the long end really breaking out of the range from last week, and which is a little bit surprising given the payroll data did come in reasonably better than expected for January. We did obviously have massively negative revisions for last year's payrolls, but bonds really have rallied. The inflation data came in a little bit softer than expected, so a little bit less of an inflationary concern. Clearly, there's worries in the bond market about AI and what it means for future deflation and profitability. I think that's coming into the bond market as well. But are there key levels here that you're watching on bonds that are tradable or can serve as a trigger for other cross asset things you're looking at?
Yeah, bonds have been. We talked about this for the last month or two. Bonds have been coiling, and ripe for a breakout. And I think that the majority of the rates traders that I know, like Donnie Phillips, and many Ira Harris and others, have been expecting a rally in the long end, and we're getting it. So the next major level in the 30. There's two levels in the 118 handle that we should pay attention to. One is 118.10, 118.10, and 118.24. So if you guys are long bonds, you can take profit at 118.10 and add above that, take profit at 118.24. That's going to be a big level, 118.24. We get above 118.24, and then we're looking at October highs of 119.19. That's going to be a huge area. So in order, 118.10, 118.24, that will be big. Above 118.24, then the next big level that it's got to test is 119.19, and then then we get above that, then we can see last year's April's highs of 122-ish. So bonds are starting to become an interesting trade again. And, I like trading markets that are breaking out, not coiling. So now that the bonds are starting to break out again, I'll be paying attention to its open tomorrow at 720. I like trading. I really, really, really like trading the long bond when it's moving. I can't stand trading it when it's, when it's not moving. It's kind of a Captain Obvious thing to say, right? I love trading markets that are moving. I love trading the bonds, though. It's one of my favorite markets to trade when there's movement in it. You can trade in and out of it pretty effectively and keep your stops tight. The margin is a little bit smaller, so you can trade a little bit bigger, and the moves are telegraphed. It's at least in my mind, it's when.
What does that mean?
When 118s are going, look at your dome. If you can see your dome, or look at the chart, I'll explain it. It's 118 even bid at 118.01. So if you're looking at it from a long, like you want to get long 118 evens, you can put in a bid to buy 5 at 118 even and not even see it trade, and you're filled, and it's still 300 on the bid. Or you're not long, you want to buy them at 118 even, you're not getting them, and ones are starting to trade. As ones start to trade out, you try to buy the last, you want to buy a 5 lot or a 2 lot or whatever, you want to try to buy them as they're going bid, you'll get them and pop their bid. 1 bid, 2 bid, 3 bid, 4 bid, 5 bid, 6 bid, 7 bid, 8 bid, and it just keeps going, So you're able to buy those 118 evens, like they're trading now. You get the edge. You can and you can also, Ninja gives you the ability to be able to adjust your stops. So, like your stop your stop becomes a stop market order when that price is triggered, right? When that price trades. But with Ninja, and I think many of the top front ends, but you can change your stop to only get triggered when there's 20 left on the bid or on the offer, or 50 left on the bid. So if it's 118 on 1,000 and somebody down ticks it, your stop isn't triggered. If 118 on 1,000 starts to trade out and there's only 100 left, and you want your stop triggered, then I don't think anybody wants me to talk about that now. But there's a lot of really good trading in the bonds, 30-year and the 10-year too. And then, my God, you can and you can really get in the weeds as you go further, into the shorter end of the curve with the K algo. That's a completely different thing. But anyway, the bonds are a great trade. It's a lot of fun to trade it. A lot of liquidity, and when they're moving, man, they move.
Yeah, look, I mean, 10 days ago or so, we were, yields were kind of approaching, through 4.85 on the way to 4.9 in the long end. People were thinking about 30 years back to a 5 handle. There was a ton of supply coming. Google was doing a bond deal. We know Treasury has massive issuance, and so the supply story for the long end was in there. And then, 10 days later, here we are, and bonds have reversed hard despite better than expected jobs data, short term. And obviously there are some issues with all that, but and then, inflation data that largely came in, in line, a touch weaker, but under the hood, clearly there is a growing fear in the bond market about either the pace of growth or future labor or what the next Fed chair is going to do, or coordination between Fed and Treasury. And so it's, the last couple of weeks, we've seen a pretty, sizable reversal here in the long end, really rallying, much harder. And so the question is, is this foreboding? Is this portend, more concern for the equity markets this week? Or will equity traders just say, great, more reason to buy stocks because we're heading down towards 4.5% as opposed to 5%? I guess time will tell on that. But I wanted to, in the last 10 minutes here, flip to one of our favorite markets to talk about, Bitcoin. Maybe Sara, if we could just throw up your Bitcoin chart there. We've talked about the divergences between Bitcoin and other risk assets for quite some time, just not really participating with general equity constructive behavior, with general risk on flavor. Certainly trailed the precious metal story throughout the up move here. There's been a couple days over the last few weeks here where Bitcoin has got absolutely shit canned. We've been talking about levels below 70,000 for weeks now. We're firmly trading below there. Where are we going next?
Well, similar to ES and NQ, Bitcoin closed as an inside week last week as well. So, I mean, I personally am not interested in a long trade here. I really still want this level taken out before I consider going in for a long-term hold. But we are at a level of exhaustion because we took out last year's lows. So what does the daily look like? If nothing else, you could get a little long here. I mean, they're probably trying to come take these guys out. So kind of looks like they're trying to trigger the inside weekend up and take out the 72 level. And I don't know how much higher they're going to get. Pharm, if you look and see, we're stuck in this another mother bar situation.
Yep.
Just chopping mother bar.
Oh, I thought you were going to say something else.
Oh, I wish I had something funny to say. No, so we call this a mother bar, and then this is the pregnant mama with the baby. It's just all stuck inside this range. So it might try and at least take that out or something. But I don't have a strong bias to the upside at all. So I would like to see it kind of do what it did back here, which is take out some highs and then come back in. Or what was that on the weekly chart? Yeah.
Mm-hmm.
So we had this mother bar here where we were this candle. We had 1, 2, 3, 4, 5, 6, 7 weeks stuck inside. We poked up and then we came back through the range. So I would like to maybe see that happen again. But that's just a lot of wishful thinking at this point. Right now we're just inside week. So we just don't know. We got to see which way this breaks. Some corrective activity would be healthy for the chart, as opposed to just inside week and down, continuing down without anybody trying to get long. So I wouldn't be against some sort of corrective activity. It doesn't have to get, or another word for corrective activity would be a bear flag in technical analysis. We try not to use that word because it's pretty subjective, but at least a higher high compared to a previous week and then back down. That's what I would want to see. Pharm, what do you think?
Yeah, I can't pull up my chart on it because with these profile templates, it'll blow it the hell up. But I agree. It just looks like inside choppy slop, and that what would be like a two-day, I guess, mother bar. Whether or not your trading view has the 2-day start on that, red candle
Yeah.
or not, it's a 2-day mother bar. I took a long at 60 and paper handed the shit out of it, pretty much where it's at, like 69,420, I think it was. It just doesn't look like it wants to go anywhere. If you look at the weekly, it's got a big ass weekly range 2 weeks ago from the week of the 2nd. Like, good luck in getting outside of that. So I don't think it's going anywhere until it's back above like 84,000 to the upside. So if you want to like really see strength, you're gonna have to at least see that. And I hate those liquidation breaks that get snap bought, like that one down to 60, is the one buying it. But I still kind of hate that because now where's it going to go, right? I almost prefer to see, a little bit more persistent downside, and that kind of a big just looks like a cover candle to me, or just everybody covered on that. And so I do see it as being stuck. So I agree. I wouldn't mind to see it come up, take out the highs of that 2-day range that it put in, and then maybe come back down and take in the lows. But I do like, considering getting long in this general area around 60, 58. I would probably do it again on another fresh low, because fail one side of the mother bar, then come down, test the other side, and you can even go right back up. So if you go down instead of going up first and sweep out that low and then come back through, you could do the same type of trade, but in reverse back to the long side. But I think you just kind of have to keep them tight on the butt coin until back above 84,000. Just hasn't shown any strength at all.
No, the fundamental story, the narrative is kind of broken. If it's not going to, be the store of value trade when gold, rips like it has, then there's issues there. If it's not going to be more of a risk on trade, like equities, when there's when there's ample liquidity, then what's the point? So it seems like it's having a narrative indigestion period here, and technically really doesn't look very good. So I think until we get more of a liquidity pump coming in from the Fed, cutting rates, doing more QE, whatever it is, or some change in Treasury issuance composition, which we're not going to get anytime soon. It just doesn't seem all that exciting. But I don't know. Around the horn, I mean, kind of the summary here it seems like more of a risk-off flavor with markets that are like on the precipice of potentially really nasty things, but no impetus for them to collapse. I mean, we talked about the strength in the long end in bonds. We talked about the equity markets looking like they're biased lower, but not breaking. Bitcoin looks bad. Crude doesn't, a bullish narrative, but price action not really as supportive maybe as the narrative. Gold and silver digesting sideways to down. I don't know. It just, like you said, Pax, it seems like we're on a ledge here. How are we going to tip over? Time will tell. But plenty to get to this week with the Fed minutes on Wednesday, bunch of macro stuff. So I don't know. Pax, last word for you, at the risk of running overtime. But I'll give you the final word this week.
My 26-year-old son called me from the mountain of Breckenridge coming down back into Denver today and asked me, Dad, should I buy more Bitcoin? I said, no, dude, don't buy Bitcoin until we get to 50. Between 74,000 and 50, I want nothing to do with it. Above 74,000, buy him. At 50, buy him. Pitch him underneath it. I don't know. I'm bearish. As long as the S&P is trading below 69.02 and 68.65. Then we'll see that last week's low. And if we can trade below, if we close below 67.96, the quarterly pivot, then you will be trading at 66.58. The previous quarterly pivot pretty quickly. We've got those old lows at 67.20, I think, to take out. But 66.58 will be the next level. The NASDAQ is going to lead the way, at least on the downside. Now, I don't know. So that's what I'm looking at. I'm not sure how the bonds, what reaction the bond is going to have with the S&P. I don't know. I'm interested to see how we open tomorrow and how we trade. It's going to be a good week. Just manage your risk. manage your emotions, manage your and listen to your gut. Okay. If you're starting to feel off, get up and walk away. There'll be another trade. Make sure you're here for it.
And with that, we'll end it for the week. Thanks everyone for joining us on this holiday edition of the Sunday Open taking place on Monday. I'm Craig Shapiro, macro strategist here at NinjaTrader Live. Join us again tomorrow morning, bright and early at 8. We got plenty to discuss this week with Deli and Shai. Great panel all week. Lynn Alden is joining us tomorrow, so definitely stick around. And thanks again for being here, guys. Have a great week.
Have a great week, everybody.
Bye.